Here's something they won't tell you on the evening news. Right now, as you're watching this video, the largest economic experiment in modern history is failing in real time. And I don't mean failing quietly, I mean producing the exact opposite results of what was intended. The kind of failure that makes you question everything you thought you knew about how global economics actually works. But here's what makes this absolutely wild. The people running this experiment, they're doubling down, tripling down actually. And every time they push harder, the results get more unpredictable. It's like watching someone try to put out a fire with gasoline, realize it's not working, and then deciding the solution is more gasoline. I'm going to show you 3 interconnected crises that are unfolding right now. Not next year, not in some distant future, right now. And by the end of this video, you're going to understand why your cost of living is about to get significantly worse, regardless of what any politician promises you. More importantly, you'll see exactly why that's happening, which means you can actually prepare for it instead of being blindsided like most people will be. So let's start with a simple question that should make you uncomfortable. What happens when the world's most powerful economic alliance with unlimited resources, unlimited intelligence capabilities, and decades of experience throws everything they have at destroying an adversary's economy? And 3 years later, that economy is not just surviving but showing clear signs of structural adaptation? You'd probably think I'm exaggerating. You'd assume that surely the sanctions are working, we just don't see it yet. The collapse is coming, it's just around the corner. That's what we've been told for 3 years straight. Any day now. Any week now. The currency will collapse, the banks will fail, the people will revolt. Political change is inevitable, except none of that happened. And the longer we pretend it's about to happen, the more we miss what's actually occurring, which is far more interesting and honestly more concerning than a simple economic collapse would be. Let me paint you a picture with actual numbers, because numbers don't care about narratives or political spin. Russian oil exports right now, at this very moment, are moving at over 4 million barrels per day. Now pause and think about that. We're 3 years into what was described as the most comprehensive, coordinated sanctions regime ever assembled in human history. Every major Western economy is participating. The legal architecture spans thousands of pages. Entire government departments are dedicated to enforcement. And yet, oil is flowing at levels we haven't seen in 3 years. You know what that sounds like to me? That sounds like the economic equivalent of declaring victory while losing the battle. But it gets so much more interesting when you dig into the details, because this is where the real story lives. Yes, Russian oil is selling at a discount, about $27 per barrel below global benchmark prices. And if you stop your analysis there, you'd conclude the sanctions are working. Russia is losing revenue. They're being punished. Mission accomplished. Except that's not where the story ends. That's barely where it begins. Track that oil on its journey. It leaves Russian ports at a $27 discount. Huge hit to revenue, right? But then watch what happens. That same oil arrives in India, and suddenly, mysteriously, the discount is shrunk to just $7.50 per barrel. So we have to ask the obvious question. Where did that missing $20 go? Did it evaporate? Did it disappear into thin air? Of course not. Money doesn't vanish, it just changes hands. And this is where the entire sanctions architecture reveals its fundamental flaw. That $20 gap is getting split up among a fascinating cast of characters. Shipping companies running what's called the shadow fleet. These are vessels operating in legal gray areas, often with obscured ownership structures. They take their cut. Trading firms willing to touch Russian oil when Western companies won't. They take their margins, often substantial ones. Insurance companies providing coverage that Western insurers refuse. They get paid too. But here's the part that changes everything. Many of these shipping companies, these trading firms, these middlemen who are profiting enormously from this arrangement, they have ties back to Russia. Some are directly owned by Russian entities. Others are controlled by oligarchs or state-connected companies through complex corporate structures, which means a substantial portion of that discount, the money that was supposed to be denied to Russia, actually flows right back through this ecosystem of intermediaries. What we're watching is economic adaptation at a scale and speed that sanctions architects clearly didn't anticipate. The system didn't break, it bent, it flexed. It found new pathways. And those pathways are now so well established that trying to close them would require a level of global cooperation that frankly doesn't exist anymore. And this brings us to India, which has become absolutely central to this story. India has gone from buying minimal Russian oil before the war to becoming one of the largest buyers. They're purchasing at a discount, refining it in their sophisticated refining infrastructure, and then selling petroleum products to markets that won't buy Russian crude directly. It's arbitrage on a geopolitical scale. Some estimates, and these are conservative estimates, put India's profit from this arrangement at $16 billion. Well, let me put that in perspective. That's not some side hustle. That's not a minor trade flow. That's real money reshaping their entire energy and refining sector. Some of the wealthiest families in India have made fortunes from this trade. New companies have been created specifically to facilitate these flows. Entire port facilities have been expanded to handle the volume. This is a complete restructuring of global energy markets happening in real time, and most people don't even realize it's occurring. You know why? Because we're being told a story about sanctions working and economies collapsing, when the actual data shows something entirely different. Now, let me pause here and be absolutely clear about something, because this is important. What I'm presenting here is analysis based on publicly available trade data, shipping records, market reports, and economic indicators. This is educational content designed to help you understand complex economic dynamics that directly affect your life. This isn't financial advice. I'm not telling you what to invest in or what to avoid. I'm not making political arguments about whether these policies are morally right or wrong. I'm showing you what the numbers actually say versus what we've been told would happen. There's a massive gap between those two things, and understanding that gap is how you make better decisions. Before we go deeper, if you're finding this valuable, if this is giving you information you're not getting anywhere else, hit that subscribe button right now. I spend weeks researching these topics, connecting dots that mainstream coverage misses entirely. Subscribing tells me this matters to you and helps more people discover this kind of analysis. Plus, with what's coming in 2026, you're going to want to stay informed. Now, the oil situation reveals something profound about the nature of economic coercion in our current world order. In a truly unipolar world, where one power dominates completely, sanctions work because there are no alternatives. You either comply or you're cut off from the global system entirely. But we don't live in that world anymore. We live in a world where alternatives exist, where other major powers are willing to absorb the trade that Western countries refuse, where new logistics networks can be built surprisingly fast, where financial infrastructure can route around blockages. In this world, sanctions don't stop activity, they redirect it. And that redirection creates winners and losers in unexpected places. India wins enormously, shipping companies win, trading firms win. And yes, Russia loses some revenue, but nowhere near the catastrophic loss that was intended. They've adapted. The war continues, the economy functions, and every month that passes, these new trade routes become more established, more efficient, more permanent. But here's where the story takes a turn that I genuinely find fascinating. Oil is only the first pillar of this economic pressure campaign. The second pillar was supposed to be currency warfare. And this is where things get truly counterintuitive, where the results are so opposite of what was intended that you'd almost think it was deliberate. The stated goal was explicit, crystal clear. Reduce the ruble to rubble. Those were the actual words used by officials. The strategy was to make the Russian currency worthless, create hyperinflation, trigger bank runs, cause financial panic so severe that the domestic population would demand change. Currency collapse has toppled governments before. It's destroyed economies. It's caused revolutions. So the theory was sound based on historical precedent. What actually happened is going to sound impossible if you've been following mainstream coverage. The ruble has strengthened by 45% against the dollar year to date. 45%. Not weakened, not collapsed, strengthened. The currency is almost back to pre-war levels. If someone showed you a chart of ruble performance over the past year without any context, you would naturally assume that sanctions had been lifted, that trade had normalized, that everything was back to business as usual. Now, before you jump to conclusions, let me explain why this is happening and why it's more complex than either sanctions failed or sanctions worked. Because reality, as usual, is more nuanced than the simple narratives we're fed. First, let's address the obvious question. Isn't a stronger currency bad for an export-dependent economy? In theory, yes. When your currency appreciates, your exports become more expensive in foreign currency terms. If you're selling oil priced in rubles and the ruble strengthens, foreign buyers need to spend more of their currency to buy the same amount. You should sell less. For most commodity exporters, this would be a serious, possibly fatal problem. But Russia's situation has specific characteristics that change this calculation entirely. Their primary export, energy, is already selling at a substantial discount to global prices. We just talked about that $27 discount. When you're offering oil significantly below market rates, buyers aren't particularly sensitive to currency movements. They're still getting a deal compared to buying from Saudi Arabia or the United States. The currency strength doesn't price them out of the market because the underlying discount is so large. So the theoretical disadvantage of a strong currency, reduced export competitiveness, is largely offset by the discount structure that's already in place. But the advantages of a stronger ruble? Those are very real, very substantial, and often completely overlooked in Western analysis. A stronger currency makes imports cheaper. Think about what that means for an economy trying to modernize and diversify. Industrial inputs, the raw materials and components needed for manufacturing, become more affordable. Machinery and technology, critical for building up domestic industries, can be purchased more efficiently. This isn't trivial. This is the foundation of economic development. Second benefit, inflation control. When your currency is strong, imported goods don't spike in price. That keeps overall domestic inflation more stable. For a population dealing with war, economic restructuring, and massive uncertainty, price stability is crucial for maintaining social cohesion. Third benefit, and this is geopolitically fascinating. A stronger ruble improves terms of trade with your biggest partner. And who is Russia's largest trading partner by far? China. Now, here's a detail that surprised me when I first dug into the data. Russia actually runs a trade surplus with China. They sell more than they buy. China needs Russian energy. They need raw materials. They need commodities. Russia needs Chinese manufactured goods, machinery, electronics, and technology. When the ruble strengthens, Russia can exchange fewer units of their currency for more Chinese yuan. They get better purchasing power for the industrial products their economy desperately needs to move beyond simple resource extraction. This creates a reinforcing cycle that I don't think sanctions architects anticipated. As Russia de-dollarizes, as more and more of their trade is conducted in rubles and yuan instead of dollars and euros, demand for foreign currency inside Russia drops. Lower demand for dollars and euros means those currencies become relatively less valuable compared to the ruble. The ruble strengthens. A stronger ruble makes Chinese imports more attractive and affordable. More trade happens in local currencies. The cycle continues. Look at what Russia is actually importing from China. This isn't luxury goods. This isn't consumer electronics for entertainment. We're talking about machinery, vehicles, and manufactured goods. This is the infrastructure of industrial development. This is how you build an economy that can sustain itself without depending entirely on commodity exports. And the ability to purchase these items more efficiently because of currency strength isn't economic collapse. It's economic adaptation and potentially the foundation for more resilient long-term growth. Here's another data point that doesn't fit the collapse narrative. Oil and gas revenue, while still significant and important to Russia, now represents only 30% of their federal budget. Compare that to 2014, when it was hovering around 50%. The economy is diversifying out of necessity. Sanctions are forcing Russia to develop domestic manufacturing, expand technology sectors, grow service industries, and dramatically increase agricultural production. This is literally the opposite of what economic warfare is supposed to achieve. Instead of creating crisis and collapse, the pressure is incentivizing exactly the kind of structural economic reforms that make a country more resilient, more self-sufficient, and harder to pressure in the future. You're not weakening the economy long-term, you're forcing it to evolve. Now, I need to emphasize something critical here. I'm not making a moral argument. I'm not saying these sanctions are good or bad from an ethical standpoint. I'm not defending or attacking anyone's policies. What I am saying is that if we evaluate these measures based purely on whether they're achieving their stated objectives, the evidence suggests they're not. And more importantly, they may be producing unintended consequences that will outlast the current situation and reshape global economics for decades. If you're still with me at this point, and I really appreciate those of you who stick around for deep analysis like this, drop a comment below. Tell me what you think. Do economic sanctions still work in today's multipolar world? Can financial weapons force compliance when alternatives exist? Your perspective matters, and honestly, reading your comments helps me understand what resonates and what topics to explore in future videos. The currency situation reveals something fundamental about how modern economics is evolving. In a world where multiple major economies are willing to trade outside the dollar system, where alternative payment networks have been built specifically to avoid Western financial infrastructure, currency-based sanctions lose much of their power. The ruble's strength isn't just about Russian central bank policy or capital controls. It's evidence of a broader structural shift in how international trade is conducted. And this brings us to the third crisis, the one that I think will define 2026 and possibly beyond. This one is just getting started. But the early warning signs are everywhere if you know where to look. We're heading into what I believe will be the most consequential commodity war in modern history. And the epicenter of this battle is copper. Now, you might have heard about the silver squeeze. Physical silver demand in China has been so intense that prices there are trading 10% above global markets. That's not normal market behavior. That's either panic buying or strategic resource accumulation on a massive scale. But silver, as dramatic as that situation is, was just the opening act. The real show is moving to copper, and the implications are staggering. Copper prices in China just hit a new record. We're talking about prices jumping 4.7% in a single move to nearly 100,000 yuan. In New York, the supply situation is even tighter. Prices climbed 5.6%. These aren't normal market fluctuations. This is confirmation of what many analysts have been warning about for months. A full-scale commodity war is coming, and copper is ground zero. So why copper? Why is this metal suddenly at the center of great power competition? Because copper is genuinely irreplaceable in modern civilization. You cannot build infrastructure without it. You cannot manufacture electronics without it. You cannot construct power grids without it. You cannot build electric vehicles without it. And most critically for what's coming, you cannot construct data centers without absolutely massive amounts of it. And right now, today, both the United States and China have simultaneously decided that securing copper supply is a matter of national economic security. When the world's two largest economies, with essentially unlimited resources, compete for a finite commodity, what happens to prices? They don't just increase, they explode. And everyone else in the world gets caught in the crossfire. Let me walk you through the timeline of how this is unfolding, because understanding the sequence of events helps you see where this is heading. China has explicitly made domestic economic growth their number one priority for the coming year. That's not rhetoric, that's actual policy. Domestic growth means infrastructure spending. It means construction. It means massive industrial activity, all of which requires enormous copper consumption. The United States, meanwhile, is quietly but aggressively stockpiling copper while simultaneously backing major domestic production projects. The U.S. government is supporting a $7.4 billion smelter project in Tennessee. That facility will produce copper along with zinc, lead, and precious metals. $7.4 billion. That's not a small investment. That's a strategic initiative to build domestic supply chains that don't depend on any potential adversary. Now here's what makes this urgent and honestly scary for everyday people. Data centers. The artificial intelligence boom isn't slowing down. If anything, it's accelerating. Hundreds of billions of dollars are being committed to AI infrastructure by every major tech company. Microsoft, Google, Amazon, Meta, they're all racing to build computing capacity. Where does all that capital actually go? Into physical data centers. Buildings full of servers and cooling systems and power distribution. And what do data centers require in truly enormous quantities? Steel for the structure, aluminum for various components, and especially copper. Copper for the wiring, copper for the power distribution, copper for the cooling systems. Projections suggest that data center construction alone could increase global copper demand by 500,000 tons annually by 2030. That's just data centers. That doesn't include electric vehicles, doesn't include grid modernization, doesn't include normal construction and manufacturing. Now think about the mathematics of this situation. Global copper supply is already tight. Supply and demand are fairly balanced. There's not a lot of slack in the system. Now add surging demand from two economic superpowers simultaneously. Add the fact that neither wants to depend on the other for such a critical resource. Add the geopolitical reality that both see technological supremacy, particularly in AI and advanced manufacturing, as existential to their future power. Add one more factor. Building new copper mines takes years, often a decade or more from discovery to production. What do you get when you put all those factors together? You get a supply crunch that will ripple through every single sector of the global economy. And most people have no idea it's coming because they're not connecting these dots. Here's where geopolitics and raw economics merge completely. The countries with the largest copper reserves and production are primarily in South America. Chile and Peru together account for about 7.6 million tons of annual copper production. That's the majority of global supply right there. Two countries. Suddenly, U.S. Foreign policy toward Latin America makes a lot more sense when you understand the resource dimension. This isn't just about democracy promotion or political ideology. It's about securing access to commodities that are absolutely critical for technological development and economic competitiveness. Whoever controls or has reliable access to South American copper has a massive strategic advantage. But here's where it gets even more interesting. China currently dominates the refining stage. They control approximately 50% of global copper refining capacity. Think about what that means. Half of all copper produced anywhere in the world has to pass through Chinese refining facilities at some point in the supply chain. That's not just market share. That's leverage. That's power. If you control refining, you effectively control who gets access to finished copper products, who pays what price, and ultimately who can build what. The United States is behind in this race, and they know it. They're trying to catch up, but catching up in heavy industry takes time and costs enormous amounts of money. Trump's tariff structure actually reveals the strategy pretty clearly if you know how to read it. 50% tariffs on finished copper products. That's designed to make imported refined copper expensive and uncompetitive. But raw copper ore and concentrates? Those are tariff-free. The message is crystal clear. America wants raw materials flowing in so they can build domestic refining capacity. They're willing to pay premiums to reshore this absolutely critical supply chain. China sees this happening in real time, and they're responding just as aggressively. They recently spent over $1 billion to acquire a major copper project in Ecuador. Now here's the fascinating part. Reports indicate they paid roughly a 40% premium over market value. They're deliberately overpaying. Why would anyone do that? Because at this level of strategic competition, securing long-term supply is worth more than short-term financial returns. They're willing to accept lower profits or even losses on individual deals if it means denying that supply to competitors and securing it for themselves. This is strategic resource competition at the highest level. This is how great powers behave when they're preparing for long-term rivalry, and both sides are signaling very clearly that they will spend whatever it takes, pay whatever premiums are necessary to secure copper supply. So what does all of this mean for you personally? For your life, your finances, your plans? Higher inflation is coming. Not maybe, not possibly, it's coming. The cost of building anything is going to increase substantially. Housing, which is already unaffordable for massive portions of the population in most developed countries, is going to get worse. Construction costs will rise. Manufacturing costs will rise across the board. And all of those costs, every single one, gets passed down to consumers eventually. If you thought the inflation of 2021 and 2022 was painful, and it absolutely was for most people, the commodity-driven inflation potentially coming in 2026 and beyond could actually be worse in certain sectors. It might not show up in the overall CPI the same way, but in construction, in electronics, in anything requiring significant copper input, prices are going to climb. And here's the really difficult part. Neither the United States nor China can back down from this competition. It's not optional for them. Both governments see technological leadership, particularly in artificial intelligence, advanced manufacturing, and green energy as essential to their future power and prosperity. Copper is the literal physical infrastructure that makes all of that technology possible. It's the foundation. Without secure copper supply, you cannot build the future both countries envision. So both will keep buying. Both will keep building. Both will keep securing supply, regardless of short-term cost. They'll outbid each other. They'll pay premiums. They'll offer political concessions to supplier countries. And everyone else in the world, all the smaller economies, all the everyday consumers, will pay the price through higher costs for everything that contains or requires copper. This is also why, and this is important for anyone thinking about their financial future, the US dollar will continue to face structural pressure. The US government is going to spend truly enormous amounts securing these commodity supply chains. That spending has to come from somewhere. It comes from deficit spending. It comes from money creation. It comes from expanding the money supply. That's dollar debasement by definition. U.S. Treasury bonds, which are supposed to be the safest, most reliable asset in the world, the foundation of the global financial system. The mathematics are starting to look questionable when you factor in the spending required to compete in this new era. I'm not saying bonds will collapse or the dollar will disappear, but the assumption that they're risk-free, that they're automatically the best store of value, that assumption is worth questioning when you see the spending commitments being made. Before we wrap this up, if this analysis gave you a perspective you haven't seen anywhere else, if it connected dots you didn't even know were there, please hit that like button and consider sharing this video. This kind of deep research content takes significant time to put together. Your engagement directly helps more people discover this information and tells me that this detailed approach resonates with you. Let me bring all three of these stories together because they're not separate phenomena. They're part of one larger transformation that most people don't see happening. We're watching the end of unipolar economic dominance. For roughly 30 years after the Cold War, the United States and its allies could use financial tools as weapons with pretty reliable effectiveness. Sanctions usually worked. Currency pressure usually created the intended crisis. Market access denial usually forced compliance. Not always, but often enough that these tools became the preferred method of exercising power. That era is ending, not because America is weaker in absolute terms, but because the relative balance has shifted. Alternative systems now exist. China has built parallel financial infrastructure specifically designed to operate independently of Western systems. Other major economies have diversified their trade relationships and reduced dependence on any single partner. Strategic resource stockpiles have been built, alternative currency arrangements have been established. When you try to use economic weapons in this new environment, they don't work the same way. Sanctions that would have absolutely crippled a country in 1995 now just redirect trade flows to different partners. Currency pressure that would have created catastrophic crises in 2005 now accelerates the move away from dollar dependence. Commodity restrictions that would have forced immediate capitulation in 2015 now trigger races to secure alternative supplies. The tools aren't useless. They still have impact. But they're significantly less powerful than they used to be, and sometimes they produce counterproductive results. That's not a political statement. That's just objective analysis of what the data shows. For you, as an individual trying to navigate this environment, This matters enormously because it shapes the economic landscape you'll be dealing with for years to come. Higher commodity prices flowing through to higher consumer costs. Currency instability, even if it's not your local currency, affecting import prices and investment returns. Shifting trade patterns, changing which economies grow faster and which stagnate, affecting global investment opportunities and job markets. The old rules, the assumptions that guided financial planning for the past 30 years, those aren't reliable anymore. New rules are being written in real time through exactly these kinds of conflicts and competitions. The people who understand this transition, who see these patterns developing early, will make fundamentally better financial decisions than those who assume the world still works the way it did 20 years ago. So let me ask you directly, and I genuinely want your perspective on this. Is the Russian economy collapsing or is it adapting? Based on the data we've looked at, exports, currency strength, economic diversification, it looks like adaptation to me. Is that good or bad? That depends entirely on your values, your political perspective, your priorities. I'm not here to tell you what to think about that. But I am here to show you what's actually happening versus what we're told is happening. Because that gap between perception and reality is where the most important insights live. Who will win the copper war between the United States and China? Honestly, probably nobody wins in the traditional sense. Both countries will end up paying far more than they wanted. Both will make strategic compromises they'd prefer to avoid. Consumers in both countries and around the world will face higher prices for years. But in relative terms, whoever builds the more resilient, diversified, and secure supply chain first will have a significant advantage in the technological development that defines the next decade. And that advantage could be substantial. The bigger picture here is about adaptability versus rigidity. Economic systems that can adapt, that can find new pathways when old ones are blocked, that can innovate under pressure, those systems survive and sometimes even thrive. Systems that rely on old playbooks, that assume past dominance guarantees future dominance, that can adjust when conditions change, those are the systems that face the hardest adjustments and the most painful transitions. We're living through one of those rare historical moments when the economic order is actually changing in fundamental ways. Not the small adjustments and tweaks that happen constantly, but real structural shifts in how global trade operates, how currencies relate to each other, how power is distributed and exercised. Most people won't even realize this transition was happening until they look back in 5 or 10 years and see the turning point clearly in retrospect. But you're seeing it happen right now, in real time. The question is what you do with that information. How does it change your understanding of where to invest, what skills to develop, what risks to prepare for? Those are deeply individual decisions that depend on your specific circumstances. But they should be informed by accurate analysis of what's actually occurring, rather than comfortable narratives that don't match reality. 2026 is shaping up to be a volatile year. Commodity prices will likely surge in multiple categories. Currency markets will remain unstable as these larger structural changes continue. Trade patterns will keep shifting as countries adapt to new realities. Political tensions will continue affecting economic decisions in unpredictable ways. None of that is comfortable or easy. But volatility also creates opportunity for those who are prepared, who understand what's happening, who can see clearly through the noise. Stay informed. Stay skeptical of overly simple narratives from any source. Follow the actual data rather than the stories people tell about the data. Understand that economic warfare in a multipolar world produces complex, often counterintuitive results. And most importantly, recognize that we're not going back to the old system. That world is gone. Forward is the only direction available, and the new system emerging will look fundamentally different from what we've known. I really appreciate you sticking with me through this detailed exploration. This is longer than most videos, I know, but some topics can't be explained in sound bites. Some analysis requires actually walking through the evidence and connecting the pieces. If you made it this far, you're exactly the kind of engaged, curious viewer that makes creating this content worthwhile. Drop your thoughts in the comments. What do you think happens next with these interconnected crises? How do you see this affecting your personal financial situation? What other topics do you want me to dig into with this level of detail? Your input genuinely shapes what I cover and how I approach it. Stay safe out there. Keep learning. Keep questioning what you're told. Keep looking at the actual data. And remember, understanding these macro trends, seeing the big patterns before they become obvious to everyone, that's how you make better micro decisions about your own life and finances. Until next time.